Before you scroll, this could save your family thousands. Real talk for a second. Most Americans think life insurance is crazy expensive, like some luxury-only rich folks or older people can afford. And that myth, it's straight up costing families real money every single year. If you're living paycheck to paycheck, juggling rent, groceries, gas, credit cards, and maybe kids on top of that, life insurance probably feels like one more bill you just can't deal with. But here's the truth nobody breaks down clearly. Life insurance isn't expensive at all. You're just overpaying because the system is built to confuse you, rush you, and scare you into bad decisions. And yeah, that sounds harsh, but it's facts. Most people hear life insurance and immediately picture huge monthly payments, pushy agents, and paperwork that feels like a tax form on steroids. So they either avoid it completely or sign up for the first thing offered, usually through work or some smooth-talking agent who is really chasing commission, not your best interest. That's how everyday families get trapped paying way more than they should for coverage they don't even fully understand. Meanwhile, the bills keep stacking up, and there's never a perfect time to deal with it. Sound familiar? You're not bad with money. You're just busy surviving. Here's the part nobody tells you loud enough. There are legit life insurance options that cost less than your monthly streaming subscriptions combined. We're talking coverage that actually protects your people, your partner, your kids, your parents without wrecking your budget. No fancy financial talk, no scare tactics. Just smart moves that work in real American households. The problem isn't the price. The problem is the lack of straight-up information. On this channel, we don't do boring insurance lectures or fear-based sales pitches. We break it down in plain English with real-life examples and hacks you can actually use. If you've ever thought, I'll handle life insurance later, or I can't afford that right now, this video is for you. Because later is risky, and affordable is already out there, you just haven't been shown where to look. Stick with me, because by the end of this, you'll see exactly how to protect your family without stressing your wallet. Let's get real for a minute. Because this is where most Americans get absolutely ripped off on life insurance. Nobody warns them until it's too late. The biggest issue isn't that life insurance is confusing. It's that the industry is built to profit from panic. Straight up, a lot of people don't realize that many life insurance agents are financial coaches or family-first advisors. They're salespeople working on commission. That means the more expensive the policy they sell you, the fatter their paycheck gets. And when money's on the line, guess what happens? They don't lead with what's best for you. They lead with what's best for them. They push high commission policies with big monthly premiums, long contracts, and tons of bells and whistles you probably don't even need. They're selling panic, not protection. Think about how these conversations usually go. An agent sits you down and starts painting worst-case scenarios. What happens if something happens to you tomorrow? How will your family survive without your income? Do you want your kids struggling? That emotional pressure hits hard, especially if you're already stressed about money. When fear kicks in, logic takes a back seat. You stop asking questions. You stop comparing options. You just want the fear to stop. And boom, you sign up for a policy that costs way more than your budget can comfortably handle. That's not smart buying. That's emotional selling. Here's the truth. Fear is a powerful sales tool. When people are scared, they overspend. That's not just an insurance thing. That's human psychology. But in life insurance, it gets dangerous because these policies are long-term commitments. Once you lock in a bad policy, you're stuck paying for it month after month, year after year. And if money gets tight, what usually happens? People cancel the policy entirely. So after paying thousands over time, they end up with nothing. No coverage, no protection, just regret. That's how the system quietly wins. Another way Americans get ripped off is by confusing more expensive with better. Agents love to push permanent life insurance or cash value policies because they pay higher commissions. But for most working families, especially those living paycheck to paycheck, those policies are overkill. You don't need a financial Swiss Army knife when all you really need is solid protection. Term life insurance exists for a reason. It's simple, it's affordable, and it does the one job life insurance is supposed to do: protect your loved ones if something happens to you. But since it pays lower commissions, it often gets buried or downplayed. Funny how that works, right? Then there's the workplace trap. A lot of Americans assume the life insurance offered through their job is enough. Spoiler alert, usually isn't. Employer-provided policies are often small, temporary, and tied to your job. Lose the job, lose the coverage. Yet people feel checked off because they technically have life insurance. That false sense of security keeps them from shopping around or learning their options. And again, the system benefits from your silence and confusion. The biggest problem of all: nobody teaches this stuff in school. We re-taught how to take out student loans, but not how to protect our families without getting played. So people rely on ads, agents, and hearsay, and fear fills in the gaps where education should be. That's why so many families overspend, underprotect, or avoid life insurance altogether. They don't trust its hand honestly. Given how it's sold, who can blame them? But here's the empowering part. Once you understand how the game is played, you stop losing. You stop letting fear make financial decisions for you. You start asking better questions. You start comparing policies, shopping rates, and choosing coverage that actually fits your life, not some agent's commission goal. Life insurance is supposed to be boring, affordable, and reliable. If it feels stressful, expensive, and overwhelming, something's off. At the end of the day, protecting your family shouldn't feel like a high-pressure sales trap. It should feel like a smart move you made with clear eyes and full control. That's what we're breaking down on this channel. No panic, no pressure, just real talk and real protection. Let's clear up one of the biggest money mysteries in America right now, because this confusion alone has drained more wallets than bad credit cards ever could. Term life versus whole life insurance. Sounds boring, sounds technical, and most people tune out right there. And that's exactly why folks get played. So let's keep it simple. No insurance jargon, no corporate talk. Because one of these can drain your wallet fast, and the other one usually keeps your money right where it belongs. Term life insurance is exactly what it sounds like. You buy coverage for a set amount of time, usually 10, 20, or 30 years. If something happens to you during that term, your family gets paid. If you outlive the term, the coverage ends. That's it. No tricks, no extras. And that simplicity is why term life is the budget king for most Americans. It's cheap, straightforward, and does the job. We retalking coverage that can cost less than your monthly takeout habit while protecting your entire household. For families trying to survive rising rent, grocery prices, gas, and childcare, term life makes sense. You're paying for protection, not promises. Whole life insurance, on the other hand, is a totally different beast. It's permanent coverage that lasts your entire life and comes with a cash value component that grows over time. Sounds fancy, right? That's how it's sold. But here's the catch: they make you pay heavy for that feature. Monthly premiums can be 5 to 10 times higher than term life for the same coverage amount. That's where wallets start crying. Most people don't realize they're relocking themselves into decades of high payments for benefits they may never fully use. And if you cancel early, you could lose a big chunk of what you paid in. That's a brutal surprise nobody advertises. Here's where people get tripped up. Whole life is often pitched as an investment. Agents talk about savings, borrowing against your policy, and guaranteed growth. But let's be honest, most Americans are not maxing out retirement accounts, don't have emergency savings, and are trying to stay afloat. Whole life only makes sense for a small group of people. High-income earners who already maxed out their 401k and IRA, business owners with specific tax strategies, or families with complex estate planning needs. If that's not you, whole life is probably overkill. Term life wins because it matches real-life timelines. Most people need protection while they're raising kids, paying off a mortgage, or covering student loans. That's not forever, that's a season. Term life covers that season at a fraction of the cost. Instead of dumping hundreds into insurance premiums, you can put the extra cash toward savings, debt payoff, or investing. That's how you build real financial security. Not by tying up your money in a policy you barely understand. Another dirty secret. Agents love whole life because the commissions are huge, like vacation level huge. That's why it gets pushed so hard. Not because it's best for you, because it's profitable for them. Term life pays smaller commissions, so it often gets brushed aside unless you ask for it specifically. That's why education matters. Once you know this, you stop feeling pressured and start making decisions on your terms. Here's the bottom line. Term life is for protection. Whole life is for specific long-term financial strategies. Most Americans just need protections, simple, affordable, and stress-free. If your budget is tight and your priority is your family's safety, term life usually wins, hands down. Don't let fancy language empty your bank account. Choose what fits your life, not what sounds impressive. Let's talk about the age game, because this is one of the biggest money leaks in life insurance that nobody warns you about. Most people think life insurance pricing is random or based on vibes. Nope, age is the heavyweight champ here. The younger you are when you lock in a policy, the cheaper it is, period. And once you understand this, it hits different. You don't get younger, but your rate can stay young, and that's how you save serious cash over time. Here's how it really works. Life insurance companies price risk, and age is one of the cleanest risk indicators they've got. A 25-year-old statistically lives longer than a 45-year-old. No shade, just math. So when you buy a policy young, the insurer is betting you're low risk and they reward you with dirt cheap premiums. We're talking real differences, not pocket change. For example, a healthy 25-year-old in the US might pay around $15 to $20 a month for a $500,000 term life policy. That same exact policy at age 35. Now you're looking at $25 to $35 a month. Still reasonable, but notice the creep. Push it to 45 and boom, $60 to $80 a month. Same coverage, same payout, way higher price. That's the age tax, and it's brutal if you ignore it. And here's the part people mess up. They say, I'll wait until I have kids, or I'll get it once I buy a house, or my favorite, I'm healthy, I'll do it later. Later is expensive. Waiting doesn't tea, just add a few dollars, it multiplies the cost for the rest of the policy term. That extra $40 a month at age 45. Over a 20-year term, that's almost $10,000 more for the same protection. That's real money you could have kept. Waiting means paying more for the same coverage, and insurance companies are perfectly fine with that. Best ages to lock in cheap rates. Honestly, the moment you're an adult with income, early to mid-20s is the sweet spot. Late 20s to early 30s is still solid. Once you cross into your 40s, the pricing curve starts getting steep, and by your 50s, it's like climbing a wall. Even if you're in great shape, age alone bumps you into higher brackets. Health helps, sure, but it can't fully undo age. That's why locking in young is such a power move. You freeze that low rate for 20 or 30 years, even as birthdays stack up. Now, let's talk real life. Most Americans aren't sitting around thinking about life insurance in their 20s. You're focused on rent, student loans, career moves, and just surviving. But that's exactly why grabbing a cheap policy early is clutch. A small monthly payment won't wreck your budget, and it buys you peace of mind. Then, when life gets heavier, kids' mortgage, responsibilities, you're already covered at a price that feels like nothing. That's financial chess, not checkers. Another thing people sleep on: health changes. You might feel invincible now, but life happens. weight changes, stress piles up, blood pressure creeps in. One doctor visit can flip your preferred rate into something way higher. Buying young isn't just about age, it's about locking in before health throws a curveball. Once you're approved, that rate is locked. Even if your health changes later, they can't raise it. That's huge. Let's kill another myth real quick. Some folks think they should wait until insurance feels necessary. That mindset costs money. Insurance is cheapest when you don't feel like you need it yet. That's the irony. By the time it feels urgent, it's already expensive. Smart moves happen before the panic. Bottom line, the age game is simple but ruthless. Younger equals cheaper. Waiting equals paying more for the same thing. Locking in early keeps your rate young even when you're not. And in a world where everything keeps getting more expensive, freezing a low cost for decades is a straight-up win. Don't wait for the perfect moment, because the perfect rate only exists right now. Let me put you on game real quick, because this is where a lot of people leave money on the table without even realizing it. Your health plays a huge role in what you pay for life insurance, and the wild part is, you, Dan T, need to turn into a fitness influencer to get better rates. Small moves can make a big difference. Straight up, this 10-minute habit can cut your billand. Yeah, that's not hype. That's how the system works. Insurance companies look at a few basic health markers, and if you know how to clean those up, your premiums drop. Simple as that. Let's start with the big three they always check: weight, smoking, and blood pressure. First, weight. You don't need six-pack abs, but insurers do look at your height-to-weight ratio. Being slightly overweight usually isn't a deal-breaker, but crossing certain thresholds can bump you into higher rate classes. Losing even 10 to 15 pounds can sometimes move you back into a cheaper bracket. That's not about Luxit's math. And you don't need a gym membership. Walking 10 minutes a day after meals, cutting sugary drinks, and eating slightly smaller portions can shift the needle fast. That's the 10-minute habit right there. Daily movement. Low effort, real payoff. Next up, smoking. This one hits hard. If you smoke cigarettes or vape nicotine, your premium can double or even triple. No exaggeration. The good news: many insurers consider you a non-smoker after 12 months nicotine-free, some even after 6 months. That means quitting even temporarily can unlock massive savings. And no, you don't need fancy programs. Free quit lines, nicotine patches, and support apps can get you there without draining your wallet. Dropping smoking status is one of the fastest ways to lower your bill, period. Blood pressure is another sneaky one. You can feel totally fine and still get flagged for high blood pressure. Stress, caffeine, salty food, and zero sleep can spike your numbers on exam day. The hack: prep like it's a test. A week before your insurance exam, hydrate heavy, cut back on sodium, skip energy drinks, and walk daily. Get good sleep the night before. Sit calmly for 5 minutes before they take your reading. That alone can lower your numbers enough to qualify for a better rate. Free, easy, effective. Here's another sleeper hack: timing your exam. Morning exams usually give better readings because your body is rested. Late day exams after work stress, not your friend. Also, don't schedule your exam right after a vacation binge or a stressful week. Insurers only see a snapshot, so make that snapshot work for you. Now, let's talk low-cost improvements anyone can do. Drink more water. Sounds basic, but hydration affects blood pressure and lab results. Cut alcohol for a couple of weeks. It can mess with liver enzymes and blood pressure. Add more fiber oats, veggies, beans, cheap stuff that improves cholesterol. None of this is extreme. It's just being slightly intentional for a short window. Another underrated move. Know your numbers before the exam. Free annual checkups, pharmacy blood pressure machines, or community health clinics can tell you where you stand. If something's off, you can fix it before applying instead of getting locked into a higher rate. Remember, once you're approved, that rate sticks. So taking a little time upfront saves you money for decades. Bottom line, insurance companies don't need perfection, they need lower risk. And risk is adjustable. You don't need to change your whole life. Just make small, smart tweaks before you apply. 10 minutes a day, a few better habits, a little prep. That's how you turn health into savings and keep more money in your pocket where it belongs. Let me put you on game real quick, because this is where a lot of people leave money on the table without even realizing it. Your health plays a huge role in what you pay for life insurance. And the wild part is you, Dan T, need to turn into a fitness influencer to get better rates. Small moves can make a big difference. Straight up. This 10-minute habit can cut your bill and, yeah, that's not hype. That's how the system works. Insurance companies look at a few basic health markers, and if you know how to clean those up, your premiums drop. Simple as that. Let's start with the big three they always check: weight, smoking, and blood pressure. First, weight. You don't need six-pack abs, but insurers do look at your height-to-weight ratio. Being slightly overweight usually isn't a deal breaker, but crossing certain thresholds can bump you into higher rate classes. Losing even 10 to 15 pounds can sometimes move you back into a cheaper bracket. That's not about looks, it's math, and you don't need a gym membership. Walking 10 minutes a day after meals, cutting sugary drinks, and eating slightly smaller portions can shift the needle fast. That's the 10-minute habit right there, daily movement. Low effort, real payoff. Next up, smoking. This one hits hard. If you smoke cigarettes or vape nicotine, your premium can double or even triple. No exaggeration. The good news: many insurers consider you a non-smoker after 12 months nicotine. Some even after 6 months. That means quitting even temporarily can unlock massive savings. And no, you don't need fancy programs. Free quit lines, nicotine patches, and support apps can get you there without draining your wallet. Dropping smoking status is one of the fastest ways to lower your bill. Period. Blood pressure is another sneaky one. You can feel totally fine and still get flagged for high blood pressure. Stress, caffeine, salty food, and zero sleep can spike your numbers on exam day. The hack: prep like it's a test. A week before your insurance exam, hydrate heavy, cut back on sodium, skip energy drinks, and walk daily. Get good sleep the night before. Sit calmly for 5 minutes before they take your reading. That alone can lower your numbers enough to qualify for a better rate. Free, easy, effective. Here's another sleeper hack: timing your exam. Morning exams usually give better readings because your body is rested. Late day exams after work stress, not your friend. Also, don't schedule your exam right after a vacation binge or a stressful week. Insurers only see a snapshot, so make that snapshot work for you. Now, let's talk low-cost improvements anyone can do. Drink more water. Sounds basic, but hydration affects blood pressure and lab results. Cut alcohol for a couple of weeks. It can mess with liver enzymes and blood pressure. Add more fiber, oats, veggies, beans, cheap stuff that improves cholesterol. None of this is extreme. It's just being slightly intentional for a short window. Another underrated move: know your numbers before the exam. Free annual checkups, pharmacy blood pressure machines, or community health clinics can tell you where you stand. If something's off, you can fix it before applying instead of getting locked into a higher rate. Remember, once you're approved, that rate sticks. So taking a little time up front saves you money for decades. Bottom line, insurance companies don't need perfection, they need lower risk, and risk is adjustable. You don't need to change your whole life. Just make small, smart tweaks before you apply. 10 minutes a day, a few better habits, a little prep. That's how you turn health into savings and keep more money in your pocket where it belongs. Alright, let's pull the curtain back, because this is where the real money-saving magic happens. And yeah, insurance agents don't love talking about this part. Same coverage, half the price, no joke. Most Americans are overpaying not because they need more insurance, but because they're shopping the wrong way or not shopping at all. Insurance isn't like Netflix. Loyalty doesn't unlock rewards. It usually unlocks higher bills. And once you understand how the game works, you can flip it in your favor fast. First big secret: comparing quotes online versus going straight to one agent can be the difference between manageable and "why is my bill so high?" Agents work for specific companies or a limited group of carriers. That means their job isn't to find you the cheapest policy on earth. It's to sell what they're allowed to sell. That doesn't make them evil, but it does mean you're seeing a tiny slice of the market. Online quote tools, on the other hand, can scan dozens of insurers at once. Same age, same health, same coverage, but wildly different prices. It's not unusual to see a $40 monthly policy sitting right next to a $75 one. Same benefits, same payout. Totally different bill. Here's the wild part. Insurance companies price risk differently. One company might hate smokers but love people with slightly higher BMI. Another might be cool with blood pressure but strict on family history. When you only talk to one agent, you're betting your wallet on one company's rules. Shopping around spreads that risk and almost always brings the price down. That's how people end up paying half for the same coverage. Now, let's talk about loyalty, because this one hurts. People stay with the same insurer for years, thinking they'll get better deals over time. Spoiler alert, they won't. Insurance companies reward new customers, not loyal ones. Intro rates are real. Discounts fade quietly. Premiums creep up slowly, so you don't notice. Meanwhile, new applicants are getting better pricing for the same policy type. That's why reshopping is clutch. Staying loyal doesn't get you a trophy, it gets you overcharged. Reshopping every few years is one of the most underrated hacks in insurance. Life insurance especially. Your health might improve. Your risk profile might change. The market definitely changes. New companies enter. Pricing models adjust. What was expensive 5 years ago might be dirt cheap today. And here's the kicker, you're not married to your policy. You can apply for a new one before cancelling the old one. If you get approved at a lower rate, you switch. If not, you keep what you have. Zero downside. Another sneaky trick agents won't highlight: policy length flexibility. Most people default to 20-year term life because that's what gets pushed. But sometimes 25 or 30-year terms are only a few bucks more per month, and that extra time can save you from reapplying later at higher rates. On the flip side, some folks only need 10 or 15 years of coverage while kids are young or debts are high. Shorter terms can be way cheaper. The key is matching the term to your actual need, not what sounds standard. Here's a real one people don't expect. Bundling does not matter for life insurance the way it does for auto or home. Agents may pitch keeping everything in one place, but that convenience often costs you more. Life insurance is its own beast. Shop it separately. Always. Timing is another quiet hack. Rates change based on your age at application or approval. Applying even a month before your birthday can lock in a lower age rating. That can save you thousands over the life of the policy. It sounds small, but insurance math is ruthless. One birthday can cost real money. Also, don't overshare without guidance. Honesty is mandatory, but volunteering extra info can hurt you. Answer exactly what's asked. No more, no less. This ISNT about hiding facts. S about not sabotaging yourself with unnecessary details that trigger higher scrutiny. Bottom line, insurance shopping isn't about trust, it's about leverage. Compare aggressively, reshop regularly, drop the loyalty mindset. The system is built to reward informed buyers, not faithful ones. Same coverage, lower price. That's not luck. That's knowing the hacks. Let us talk about something a lot of people think is a safety net, but can low-key be a trap if you don't understand its employer life insurance. On paper, it sounds clutch. You get coverage through your job, it's cheap or even free, and you barely have to think about it. But here's the truth nobody spells out. Your job's insurance quits when you do it. And that's where things get risky. If you're not paying attention, employer life insurance can be helpful, but only if you know its limits and don't treat it like the whole plan. Most workplace life insurance policies are group term life. Translation: basic coverage, usually 1 or 2 times your annual salary. If you make $50,000, you might have $50,000 or $100,000 in coverage. That sounds decent until you actually run the numbers. Funeral costs alone can hit $15,000 to $20,000. Add rent or a mortgage, car payments, credit cards, student loans, childcare, and everyday bills, and suddenly that coverage looks real small, real fast. It's not designed to replace your income long term. It's designed to be a starter layer, not the full shield. Another thing people miss is what work policies don't cover. Most employer plans don't let you customize much. You don't get to pick the term length. You don't always get to increase coverage beyond a certain cap without medical exams. And if you leave the job, quit, get laid off, switch careers, that policy usually disappears. Poof. No grace period, no loyalty bonus, no thanks for your service. That's why relying only on your job is risky. Life doesn't pause just because your employment changes. Here's where it gets even trickier. People stay in jobs they hate because they're scared of losing benefits. That's insurance holding you hostage. If your life insurance only exists because of your employer, your freedom shrinks. You hesitate to make moves. You tolerate bad situations. That's not protection, that's pressure. And in today's economy, job hopping is normal. Layoffs happen. Industries shift. Betting your family's security on your employer's stability is a gamble. Most people don't realize they're remaking. Now, let's talk about stacking coverage smartly, because this is where employer life insurance actually shines, when you use it as a bonus, not the base. The smart move is having your own individual term life policy first. That policy follows you no matter where you work. You own it. Then you stack your employer coverage on top of it. Think of your personal policy as the foundation and your work policy as extra padding. If something happens, both pay out. That's how you build real protection without overpaying. Another sneaky detail: some employer policies reduce coverage as you age. Yep. Once you hit certain age brackets, the benefit amount can quietly shrink unless you pay more. Others increase premiums automatically over time. Since it's deducted from your paycheck, people don't notice the creep. You just see a slightly smaller check and shrug it off. Meanwhile, you're paying more for less coverage. That's not the move. Portability is another buzzword you'll hear. Some jobs let you convert your group policy into an individual one when you leave. Sounds good, right? The catch: converted policies are usually way more expensive and often become whole life policies you didn't ask for. No shopping, no comparison. Just take it all of it pricing. That SY locking in your own policy while you younger and healthier is such a power play. Here's the bottom line. Employer life insurance is fine as a perk, but it's dangerous as a plan. Use it to supplement, not substitute. Your job is not forever. Your responsibility to your loved ones is don't let convenience fool you into false security. Get your own coverage, stack it smart, and keep your protection independent. Because when life hits, you want your insurance to stay solid even if your job doesn't. Let me make this real. Because insurance talk can sound abstract until you see how it plays out in everyday American lives. These people saved thousands by switching one thing and no, they didn't win the lottery or suddenly get rich. They just stopped overpaying and started moving smarter. Same families, same income levels, same responsibilities, just better decisions. If you see yourself in any of these situations, pay attention because this could be your wake-up call. First up, the single parent grind. Picture a mum in her early 30s, working full-time, juggling daycare, rent, groceries, and gas prices that never chill. She had a life insurance policy she bought years ago because an agent scared her into it. Whole life. Sound familiar? She was paying about $180 a month for $100,000 in coverage. That's over $2,100 a year. After reviewing her needs, she realized she didn't need a forever policy. She needed income replacement while her kids were young. She switched to a 20-year term life policy for $500,000 in coverage at $35 a month. Same peace of mind. 5 times the coverage. Monthly savings about $145. Over 20 years, that's nearly $35,000 saved. One switch, life-changing difference. Now, let's talk about a young married couple, mid to late 20s. No kids yet, but planning ahead. They both had employer life insurance, one-time salary and thought they were covered. Spoiler, they weren't. Combined, they had about $120,000 in coverage. That wouldn't even touch a mortgage, let alone replace income. They shopped for individual term policies early, before health issues and age bumped up rates. Each locked in a 30-year term for $750,000 at around $30 a month each. Total cost $60 a month. What did they change? Timing. They applied early instead of waiting. That move alone saved them tens of thousands compared to applying in their 40s. Same coverage, way cheaper, locked in while rates were young. Now, the middle-class family scenario. 2 parents, 2 kids, household income around $90,000. They had life insurance policies scattered everywhere, one old policy from years ago, one through work, one accidental policy they forgot they even had. Total coverage was messy and overpriced. They sat down, mapped out their real needs mortgage balance. Childcare, college goals, and income replacement consolidated everything into 2 clean term policies. Here's the common thread in all these stories. Nobody needed more insurance. They needed better insurance. They didn't change their lifestyle. They didn't give up coffee. They didn't work more hours. They switched one thing. Policy type, timing, provider. That's it. And those small switches stacked into massive savings. This is why knowledge beats hustle every time. Insurance companies make money off confusion and complacency. The moment you slow down and look under the hood, the numbers change fast. If you're repaying more than $50 to $60 a month for basic term life and you're relatively healthy, you should be asking questions. If your only coverage is through work, you should be shopping. If you've had the same policy for over 5 years and never requoted, you're probably overpaying. Bottom line, real families aren't doing anything fancy, they're just switching smarter. And that one move, it adds up to thousands staying in their pockets instead of funding someone else's commission. Let's keep it 100 as we wrap this up. Because life insurance isn't about doom and gloom ads or agents blowing up your phone. It's about peace of mind, plain and simple. Knowing that if life throws a curveball, your people are still straight. Rent gets paid, groceries stay in the fridge. Kids don't have to figure it out while grieving. That's the real flex, not some overpriced policy draining your bank account every month. Protecting your family shouldn't feel like a punishment, and it definitely shouldn't feel like a scam. Fear-based selling is loud, but smart protection is quiet, calm, and calculated. Here's the truth most folks never hear. Good life insurance is boring, and that's a good thing. No drama, no confusion. Just coverage that does its job when it's needed most. You don't need the fanciest policy on the menu. You don't need bells, whistles, or a 30-page brochure full of guarantees. You need something affordable, locked in at the right time, and matched to your real life. That's it. When you buy out of fear, you overpay. When you buy with clarity, you save serious money and sleep better at night. And let's be real, someday is the most expensive word in personal finance. Someday I'll get coverage. Someday I'll look into it. Someday I'll clean this up. Meanwhile, rates creep up, health changes, and life keeps moving. The smartest move is action, not perfection. You don't need to know everything. You just need to start. Get a quote. Compare options. Ask better questions. Even taking 20 minutes today can literally save your family tens of thousands over time. That's not hype, that's math. If you've been nodding along through this video thinking, yeah, I need to handle this, take that as your sign. This isn't about being rich. This is about being responsible without going broke, about choosing protection over panic, about playing defense for the people who count on you. Because when something happens, something always happens you. Don't want stress stacked on top of loss. You want answers. You want stability. You want your family taken care of without scrambling or GoFundMe links. Remember, insurance companies are businesses. They don't wake up thinking about your kids or your spouse. That part is on you. The good news. Doing the right thing doesn't have to be expensive or complicated. Once you know the hacks, the game changes. And now you know them, you're not guessing anymore. You're moving with intention. If this video saved you some mental stress or opened your eyes even a little, do me a favor, hit that like button so more people can see this. Subscribe to Insurance Hacks America because we drop real, no BS money-saving insurance game every week. And jump in the comments, tell me where you're at. Do you already have life insurance? Are you shopping right now? Or did this video finally push you to stop procrastinating? Because if your family matters, and I know they do, this decision can't wait. Hit subscribe. More insurance hacks coming. Alright, let us break it down real talk style. The moral of all this life insurance hustle isn't about being fancy or stacking policies just to flex. The real lesson: protection over panic, clarity over chaos, and action over someday. Too many Americans get played because they think life insurance is some complicated, expensive nightmare. Nah, it's not that. The real ripoff happens when we let fear run the show, buying whatever shiny policy an agent shoves in front of us, paying more than we need to, or putting it off until we're older, less healthy, and way more cash-strapped. Here's the straight-up truth. Life insurance isn't about getting rich. It's about keeping your people safe, your bills covered, and your peace of mind intact. When you handle this right, you don't need to stress if life throws a curveball. Kids covered, mortgage covered, emergencies. You got this. The hacks we went over, like knowing when to lock in a policy, comparing quotes, understanding term versus whole life, and tweaking your health habits, are all about playing smart, not overpaying. And let's not sleep on the procrastination trap. I'll do it later is the silent wallet drainer. Rates go up, health changes, and suddenly you're paying double for the same coverage. Moral here: don't wait. Start small if you gotta, but start, compare, ask questions, lock something in, and keep your families back. Life is unpredictable. You can't control everything, but you can control whether your people are taken care of. So the takeaway is simple. Life insurance is power when used right. It's not a scary expense, it's a tool that saves you money, saves your loved ones stress, and gives you confidence that you're not leaving anyone hanging. Stop buying into fear. Stop waiting for perfection. Take control, shop smart, and protect your family without going broke. That's the real flex. That's the moral. Protect your people, save your cash, and own your peace of mind. No excuses.